evening. This is the faculty presentation for Penn State University. My name is Diodato. I'm going to be talking tonight, hopefully trying to convince some of you about the viability of technical analysis. If not convince you, perhaps just teach you a little bit about how it works, and who knows, maybe give you some intellectual ammunition for the next time that you get into an argument with a technician. So, obviously, introduction to technical analysis. First, I'd like to thank every single one of you for coming here tonight with an open mind. Honestly, when I sent out the invitations, I was pretty nervous to see about actually how many people would actually reply. As right here, a quote from my dear friend and also very accomplished technician, retired at I think like 35. He said, when I was talking to him about this presentation, talking about technical analysis to professors, wow, if you have a bulletproof vest, you better wear it. And that's Tom Bolkowski, and he's also a statistician, works a lot in the area of making technical analysis more of an objective subject. So, a little bit about myself. This is only my second semester here at Penn State, so I haven't really gotten to meet most of you, but my name's Chris. I'm obviously an uppity market technician with, I only have one more semester until I graduate. Yeah, I'm a fresh transfer student. And I've actually been teaching myself TA, technical analysis, since I was age 17. I pretty much fell in love with it as soon as the Great Depression, the Great Recession hit. Watching those enormous swings that were sometimes caused by news, but other times just caused for the sake of being caused. That's how I got into it. Currently, I'm enrolled in the Charter Market Technician program, also called the CMT, which is basically the technical equivalent of a CFA, which I'm sure all of you know about. At this point, there are 3 exams just like the CFA. I finished my first and my second. I finished my second back at the beginning of last October, and I'm scheduled to do my third exam on May 5th, and I'm not going to say pass it because I think it's going to be pretty tough. Anyway, with my second exam, just like the CFA, I'm Series 86 certified, or the correct word would be exempt, and my specialty is technical analysis, and obviously I'm scheduled May 5th. Okay, so goals this evening. First thing I want to do is suggest that the main stock evaluation theories, I'm going to just point off the main 4 that we generally hear in the news, on CNBC, in the other forms of media, newspaper or whatever. Efficient market hypothesis, random walk theory, which I'm going to put under the same umbrella, modern portfolio theory, which is taught extensively here at Penn State, fundamental analysis, which is taught a little bit here, and then finally, of course, technical. I want to suggest that each one of those 4 theories is just a way of thinking, and each way of thinking has its advantages, it has its disadvantages. Each theory has its downfalls. Nothing's really perfect. That's actually the beauty of trying to analyze the market. There is no single equation that can tell you what it's going to do. It's a mixture of things. Then after that, I want to talk about intermarket analysis, which is a cornerstone of technical analysis. Most people, when they think of TA, they just think patterns. But intermarket analysis is an analysis of the interplay between, say, equity markets, so stock markets, domestic and international, commodity markets, currency markets, and bond markets. You'd probably be surprised that each one of them is very related to the other markets, and they actually follow very reliable historical patterns in terms of peaking and troughing and with cycles and that kind of thing. Then after that, of course, I want to address any questions about technical analysis you have. It's most of what you hear in the news, frankly, about technical analysis. I think you hear golden cross, moving average, support, resistance. There's so much more to that. Then I want to suggest a change to the academic curriculum, or at least put it in your mind that to make your students more well-rounded, to make them more prepared for the job market, add a little technical analysis in the curriculum. Add a little bit on trading methods. So those are the goals this evening. So first, every time that I'd start talking about this to a professor, they'll say, studies really don't say that it's really a good way of analyzing things. So I want to address the empirical evidence against TA. First, the first studies that they did were on TA, and most of them subsequently, they basically just did linear autocorrelation studies, and it measures the correlation of historical prices to current prices. That's what technical analysis is. We predict the future based on historical price action, based on historical patterns. The studies showed that price changes were linearly independent from previous price changes. So that, quote unquote, was supposed to nix technical analysis as a field of study as a whole. The thing is, they can only detect linear dependencies. Markets are not that simple. I don't think that many things that deal with mass psychology are that simple. And actually, if you want to look into studies that didn't rely simply on linear autocorrelation studies, look at studies by Lowe, McKinley, and Edgar Peters. They actually use things like neural networks, multivariate solutions, and they actually have a book. It's very academic, meaty, good stuff that professors like. It's the book A Not So Random Walk Down Wall Street. Of course, it was I think it was Malkiel who wrote the first book, so it was kind of like an academic refutation. But anyway, they found that trends and patterns do in fact exist in markets. And I'm sorry, I'm so biased. I do love technical, so I have to do some studies against random walks. Sorry for those that believe in it. First, it's assumed that with higher returns, there must be higher risk. Always, according to the Kaplan model. Or I think that a couple of them deal with standard deviation as a risk factor. And after that, then came factor models. Studies that say low PE stocks, low PB stocks, price to earnings, price to book, tend to outperform. Then, another study, invest with stocks with good earnings surprises, with technical confirmation, which that would be increases in volume. So Apple has great earnings, the stock goes up 4%, it's on high volume. There's probably going to be a persistence of that momentum. As you see, average annual return of 30% in 4 weeks. That's pretty good, without taking much more risk. Invest in stocks with high relative strength for intermediate time frames. This has actually been very studied. Relative strength analysis, that stocks that outperform tend to keep outperforming. For how long? About 5 years. See? Strong trends have a tendency to reverse after about 5 years. So if Apple's in this skyrocketing motion, when it reverses, it's going to reverse pretty hard. But simple as this, high relative strength stocks, they tend to outperform it. Actually, there's a study that we had somebody come here, his name was Jeff Spots, and he runs, I think it's called the Prophecy Fund. It's a hedge fund. And he actually was digging through some studies and found he took about 50 different strategies. And they're like, invest in low PB stuff, invest in high PE stocks, and it was just all these different factor models. And it came out in the end, the top three strategies, number 2 was 12-month high relative strength versus its peers. The number 1 was actually volume increase, which actually, if you dig into that deeper, it actually showed that stocks that outperformed most were the ones that had institutions going after it. What brings stocks up? Money. What do institutions have? Money. Money, demand, higher stock prices. Outperform. I think number 3 was, I think it was PE ratios. It was actually something pretty fundamental. Okay, so, final one. Trading volume increases with price momentum. Gives returns 15% above buy and hold. We can actually translate that to breakout trading. Okay, so I gotta go back against EMH, random walk again. You can't do this in a theory. If you're going to say that If you're going to say that to get higher returns you must take more risk, and there's contradicting evidence, you need to pretty much scrap the theory. What happened when there's contradicting evidence? For instance, the price to book effect and the price to earnings, the small cap effect. Small caps tend to outperform large caps. Very prominent in the 80s. They changed the theory. They said inherently small caps have a higher default risk. Inherently, low price to books, they have more risk. And they actually changed the theory to make it immune to contradicting evidence. You can't do that. In any rigid science, you can't do that. So, actually, this theory nixed EMH. Like I said, it gets nervous, scientific treason. But then behavioral finance came out of it, which came out with that, like the Fama French models of pretty much going off of this stuff. Doing portfolios where you'd say, let's buy the lowest 10% PE stocks, the highest, and we'll short the highest 10% of PE stocks. And we'll see how those portfolios are doing. And actually, their website has all these model portfolios that have like momentum, value, probably relative strength. They have a lot of them. So, factor models. Okay, so part 2. The theories, each one. Random walk. It's been great how much this one has been studied. And it's actually really good how much this has contributed to academic finance. The what would I say? I think it was the guy who put across efficient market hypothesis. I think he won a Nobel Prize, right? Anyway, it works extremely well in a vacuum. It's been studied and it's pretty much supported. It's pretty well supported, even though I disagree, and all of you have the right to disagree with what I agree in or what I believe in. It's no problem. We're in an academic setting. We can just have a friendly debate. And it also gives the average investor confidence in buy and hold. It basically says, take the money, index it, you can be your own financial boss. That's fantastic, right? Yeah. Disadvantages. It says nothing about extremely successful investors like Warren Buffett, Paul Tudor Jones, Jesse Livermore, all these people, and like Peter Lynch. It just says they're lucky. They won't outperform forever. They're going to crash and burn. I don't know how much longer Warren has to crash and burn, but for the past, I think, 82 years, he's doing pretty well. It doesn't really take into consideration speculative bubbles. It just says that when new, relevant information comes out, that is the only time that price should change meaningfully. Any other price change is noise. Think about the 1920s, late 1920s. Think about the dot-com bubble. Was all of that overvaluation back then? Was it really not overvaluation and a reflection of what really, what the news and all information really set forth? I really don't think so. With PE ratios of the S&P 500 more than double of their historical average, on a quantitative measurement, it was overvalued. EMH says nothing about that. It says that it can't happen at all times. The price is fair, even though markets can be overvalued for years, months, decades even. And of course, I already mentioned this, they had to change the theory to accommodate contradicting evidence, which you can't do. And finally, the irrelevance to price movement versus news. And I'm sure that you can remember this, or try to. 1987, what happened that day? Anyone? Nothing. It was essentially price movement down caused program trading to sell. That brought prices down even further. Normal investors saw this price movement. They sold. It kept turning into a vicious circle, negative bubble. But was there any news that day? No. Actually, 10 out of the largest 13 U.S. stock declines had really no relevant news that day. Black Thursday, or let's just say the entire 2 weeks of the crash in the Great Depression in 1929. Did anything really happen back then? You look in the news? No, not really. I think that the president bought like himself a boat I think that they signed a law. It wasn't like a tax or a tariff law. I think it was that. No, they actually wanted to lower a tariff, but really nothing happened. It's price movement caused mass psychology, mass herd behavior, mass panic, which caused more price movement. Next one, modern portfolio theory. This is what we teach in school a lot, and it's really good for like asset allocation. It's fantastic. So like advantages, it's very mathematical, it's very objective, there's no really art to it, it's a good topic, and it really quantifies the benefits of asset allocation, diversification, and there really wasn't a way to quantify this beforehand. It was just, I think in my Finance 305 class, we were talking about this portfolio that was invented back in BC's, thousands of years ago, that just said, I think it was a third of your money in real estate, a third of your money in the bank, and a third of your money in gold, or something like that. And it was just these naive strategies, these rules of thumb. Modern portfolio theory, they changed that forever. It was fantastic. And now it says that everyone can find their own model portfolio. That's great. And it also allows one to plan for the future, for their retirement, via expected returns and volatility. Now the disadvantages. It's still buy and hold theory, which it makes investors hold during downturns. Nobody wants to hold during downturns. I feel so bad for the broker that said in the 1980s, as the Japanese stock market was crashing, he was saying, no, your Japanese stocks are fine. They have an expected return of this. Don't worry, we'll just hold on to it. It never happened. Or the investor in, say, in 2008, that his broker bought Citigroup or Bank of America, and he was saying, as he was looking at a 95% loss and 90% loss, the broker was saying to his client, no, don't worry, don't fire me. It's fine, it'll go back up. It always goes back up, even though it doesn't, and it didn't. Look at a price chart of Citigroup. It's absolutely depressing right now. Alright, never mind. So it still relies on that, and there's no exit plan. It's basically just, if you have enough money and you want to retire here, then you take it out then. That kind of failed in the last 10 years. As you see, people aren't retiring because they don't have the money. Like back in the 90s, you wanted to retire, fantastic. But after the baby boom, after everyone wanted to pull their money out of the market at the same time, you couldn't. You didn't have enough money to retire anymore. So there's no exit plan, there's no real risk management plan, aside from just eliminating non-systematic risk. Another weakness, to use a standard deviation as a measure of risk. Think about it this way. If we have a stock, and the, let me get lights a little brighter in here. There we go. If we have a stock that normally does this, does a little climb or whatever, and we say its risk is equal to 5%. This guy, he bought right here, let's just say $10. Suddenly they have fantastic earnings. Stock goes up to 50 and hangs out. Just because of that gap, this person, he just made 500% on his stock. He loves it. But because it went up that fast, suddenly the risk is now 30%. People think that risk is only risk of losses. Risk of gains, there's no such thing. If you want to give me 500% return on my stock, I'm fine with it. That is not taking a risk if that happens to me. If I make a 500% return, I don't say, oh, I need to get out of that, it's risky. I say, wow, wow, I feel good. it's better to use something like an Ulcer index, which actually measures drawdowns versus the point of buying and the duration of holding a loss. That's what's painful. And take it from me, and probably take it from all you, it's very painful to hold a loss. It's very painful to hold a loss and to see a loss get even greater. And then expected return phenomenon, technical analysis, predicting the future based on historical prices. Expected return, you're doing the same exact thing. You're predicting future returns based on past returns. And panic markets and correlation, unfortunately, as I'm sure that you saw in like 2008 or whatever, in panic markets, diversification gives you no benefit at all. Everything down. Going up it might, going sideways it might, but when there's a crisis, every market goes down. Everything. Okay, so we have correlation there. And then fundamental analysis. It's good. It's it's once again very objective way of analyzing a stock. You do discount cash flow or estimate the free cash flow of a company, and it's a rigid academic system, which having a system in place is extremely important in making money in the market. And you can apply it to any stock. And even if the stock doesn't have earnings, there's other ways to do it. You can do like, even though in the .com era, cost per click. It's pretty tough to estimate earnings off of that, but there's always different things, like you can price the book. It gives you an exact price target, which is pretty rare in most strategies. And the CFA designation, which is for fundamental analysts, that is so respected. I think it's probably the most respected financial certification in the investment industry. Disadvantages. The growth rates are highly sensitive. I know you know the equation. It's, I think, DO over R minus G. If your G is off by 1%, you might accidentally wind up doubling your stock target. So you have to be spot on with the growth, and that's pretty subjective, unfortunately. If you don't have access to talking to the CEO of the company and looking at the company yourself, you need to rely on other analyst growth rates. So you got to go on Yahoo Finance, and you just have to use someone else and hope that they're right. A good bit of fundamental analysis brushes aside macroeconomic conditions. It seems that the goal is less make money, but more find the best company. So during like a 2008 recession, no, we're still buying. We're still buying, long only. And you can't use it for short term. Even a relative valuation strategy, you really can't use it for short term, like intraday. You can't day trade on it. And then finally, and I'm sorry I'm biased, technical analysis, it's a giant, broad field, but its biggest advantage, which I will shine the laser pointer on it, it has an entry and an exit plan. Risk management is the key thing in it. Even if all fields of technical analysis, even if random walk was right, and all fields of technical analysis were wrong, we have a risk management plan. That's why we're better off. We use other things we use, probability theory to predict moves, like that man Volkowski I was talking about. He actually got probabilities that different price patterns would hit their targets or move in whichever direction. You can use it to day trade. You get price targets just like fundamental analysis. And there's high demand for career technicians because it's definitely in use. But the thing is, the only ones that are really available, and actually when I had my interviews, they mentioned this to me, the only ones that are available are ones that taught themselves. So there are very few available. This is a great opportunity for Penn State to be one of the first in line to send their students to become technicians in an industry that is just looking for this type of talent. Now, of course, I need a drink of water before I talk about all the disadvantages of technicals. If you are a swing trader, even if you're a long-term trader, a trend follower, you're going to have so many small losses, you're going to hate it. You're going to hate it so much. I think that the typical technician that is successful, 35 to 40% of their trades, they're right. So what do you have to do? Make the winners big, keep the losses small. Some methods are very subjective. It's half art, half science, and some topics like Elliott wave analysis, which is a lot what I do, they're extremely subjective. Well, they don't seem subjective after you get used to it, but at first glance they seem so subjective, and you can almost conjure yourself to be right always, looking after the fact. In some of the things, there's no reason that they work. Why on earth should a stock that does this pattern, which is called a head and shoulders, why on earth should it go down exactly the same distance as the height of the pattern? That's how we predict price targets in pattern analysis. Why? Not really many explanations about that. It's also difficult to explain. It's tough to tell a client, why are you buying this stock? I drew a bunch of lines on it. Now, of course, there are technical analysts who are successful that know much more about it, and they also combine it with fundamental analysis, so they can actually put their ideas in a much better fashion. But if you say I drew lines on charts, the client's not going to like that. It's not easily testable, since some things are really subjective. Some methods are testable, though. I will talk about program trading and optimization. And finally, it's emotionally exhaustive. Taking a loss 2/3 of the time, that's emotionally exhaustive. Sometimes you might even have a streak of losses. It's extremely emotionally exhaustive. Learning how to manage your own emotions and to become disciplined and watch the market put you so far into the ground and to try to keep you there, and you trying to get back up, that's emotionally exhaustive. But when you do get up, you'll be the next Paul Tudor Jones, the next great trader. It's just part of learning. And what else do I want to talk about? Oh yeah, the final thing, and I was actually talking to someone from Fidelity today. He said, one of the best things about technical analysis, he said, I can analyze 50 different stocks in about 20 minutes. He's like, I can analyze 50 different charts in about 20 minutes, and I can give you an opinion. Now, of course, if I spent more time on a certain stock, my guesses would probably be more correct, but regardless, show me 50 stocks, I'll give you 50 buy, sell, hold recommendations. 20 minutes, like that. Another benefit, doing DCFs and digging through those income sheets, even though some people like doing it, takes a little while. Bottom line, after everything's been said, we're all nuts. We're out of our minds. Random walk relies on this pristine theory that has been refuted many times. Modern portfolio theory relies on expected returns to keep resuming. Fundamental analysis believes that a company has an intrinsic value and it will grow forever. Technical analysis, you're drawing lines on charts and doing ratios and momentum, other kinds. You're doing things that, let's put it this way. When I tell somebody I can trade a stock without even knowing its name, they say I'm nuts. But I can. But each strategy has its own advantages. I need to put that out there. Okay, quick words about risk. I'm just going to draw this up on the board. And this is how a friend put it in terms of what academia agrees with and what they don't disagree with. I think that the entire idea of being in the investment world is to manage your risk. I think that returns are cool, but what we care about most is risk, losing money. In MPT, we call risk sigma, standard deviation, which is the volatility of returns. We called it then beta, which is a measurement of systematic risk. We said the higher the beta, the more risky. The higher the sigma, the more risky. Then, after academia accepted that, academia with the help of Fama, French, they accepted factor models. And I might be in the wrong order. So, factor models. What's that? PE, PEG, PB. Ratios. Low PE ratios. If everything else is equal, lower risk stock has a lower PE ratio. Higher risk stock has a higher one. All other things equal. PEG. Lower, the better. Lower, the lower risk it is to invest in it. Price to book ratio. The lower it is, the lower risk is to invest in it. Then, after that, fundamental. DCF models. If the DCF model gives us an output price that is currently higher than the current price the stock is trading at, it's low risk to invest in it. Right, Mr. Buffett? Right, the fundamentals in here? Right, the CFAs? That's right. So, it's all a matter about risk. Technicians, we look at risk a different way. We'll say price is relatively overbought or oversold versus other times. If it's oversold and we do some other analysis, it's low risk. That's how we're going to state it. Other things, we'll see a trade and we'll say, okay, if I make this trade, there's two results. Game theory time. Two results. I can make 20% or I can lose 2%. That's cool. It's basically if I flip a coin, lands on heads, I get 20 bucks. If it lands on tails, I get 2 bucks, and it's a 50-50 chance. Okay, that's low risk. I'll do it. So it's just different ways of looking at it. And perhaps if I put it that way, it's a little more easy to accept as a valid way of thinking. So just some quick words about risk. Part 3, what is technical analysis? I've probably harped on this many times already. You can read the slide for yourself. It's essentially reading the result of supply and demand. So, Tom DeMar, he's a famous technician, really famous for making objective methods of analyzing and trading. He said technicians are parasites. He said they can trade a stock without knowing its name, which I do all the time, which many technicians do all the time. And he said they'll see a trend and they'll ride it for no reason. Just because demand is high on that stock and they think demand's going to stay, they'll buy it. That's what we do. We analyze supply and demand and we follow it. Now, when I went and invited people to this presentation in their offices, delivered my letters, a lot of them, they brought up about technical analysis. They're like patterns, 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 patterns. If you see one pattern, it might be something else. Patterns, 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 patterns. There's so much more to technical analysis than that. We have the technician versus the actual technician, i.e. like a CMT or something. The technician looks for price patterns, doesn't have a risk management strategy, finds a pattern, buys it because he sees a pattern, not because the pattern put out a signal, buys it when he sees a pattern, gets a price target. That's good. He's got kind of a method, no risk management plan. If he's wrong, 9 out of 10, he's a human being, so he'll say, I can't be wrong. I will stay in it. It'll go back up. And no emotional control. The real technician looks for price patterns, key ratio levels, looks for proportions in markets, relative strength, creates formulas that quantify the relative strength of the stock, plot cycles using like spectral analysis or Hearst, or I think that spectral is the big one, analyzes the macro trend. So like a lot of technicians are top-down people. If the market's going up, everything else is going up, then maybe I should buy this stock because everything else is going up and it looks like it's especially going to outperform. Analyze the macro trend, plus ratio, pattern, reverse engineered targets. There are a lot of formulas in technical analysis. You would not believe how much math there is. I do spreadsheet after spreadsheet after spreadsheet. I do models too, and it's a lot of math. And you can actually like take these formulas and you can actually get price targets from them. You can reverse engineer them, basically just do some really intense algebra and write a macro to do it. I do that all the time. Now if you're more of a program trader, which is between a technician and a quant, you can create a trading system, automated or not. The system that I do, it's not automated, but it's still a system. Most of my trades are the same exact, I look for the same exact criteria, same exact time frame, and I follow the same exact strategy to the T. Don't violate the plan. But you can also do automated ones, computer ones. You can optimize them. So like backtest, get the best strategy for the situation, and there's special ways to test data and like how to sample data to try to get the best thing you can, like neural networks, genetic algorithms, those kinds of things. Yeah, technicians, we know about that. Create an exit plan, and finally, most important, we follow the strategy. So that's the difference between the technician and the real technician. Examples, and here it comes. Get ready to see how crazy we can be. Okay, well first, there was a day that Apple went up to about, I think it was, they opened at 510, they got up to 520, and then they closed below 500. I got my friends into an Apple trade before, and they were on extremely high margin. They called me and they said, what's happening, what's happening, what's happening? I said, hang on, calm down. This is the worst that can happen. So I made this spreadsheet of a momentum indicator. I got a target off of it, and then I got a target price off of this. It was trading at about 497 by the end of the day. I said, look, don't worry. The lowest this should get is 487. And if it gets lower, you need to get out. But if it gets to 487, don't worry about it. That's the worst case scenario for right now. And it calmed them down. And Apple's, I think it's about 600 right now. And once again, Apple. Okay, here's the controversial analysis. I love Elliott wave. This is Elliott wave analysis. We can get exact price targets. We can get support and resistance levels. As far as accuracy goes, it's pretty accurate a good amount of the time. And you can, instead of really using Elliott wave to predict what's going to happen, it's better to predict what can't happen. Now, I blatantly violated that in this. I said in this 5-year weekly chart, I sent to my friends that I got into Apple, I said, it's going to run into a brick wall at between 548.17 and 552.56. It just has to. But I think it'll go up still after that. And they're like, okay, that's fine, you're crazy. The exact high was 548.17 that day. Maybe it was luck. Whatever it was, they think I'm a magician now. Okay, pattern trading. This is what you're probably familiar with. This is a symmetrical triangle. And this pattern, you would buy at the, I don't have my laser pointer. You would buy, you would buy right there, at the breakout point. And there it is. And you have a price target, you have a risk management plan. My risk management plan, I believe, was a breakdown to 200-day moving average. So I bought it about 27, and I was expecting it to get to, you take the height of the pattern, you project it off the top, I expected it to get about 35 bucks. That's actually where I hedged myself, 35 bucks. I used momentum to confirm the breakout, and actually, momentum broke out before the price did, so I knew there'd be a buy signal coming by soon. And then, let's see, earnings gap, which was another technical confirmation. And there's my risk management strategy, probability analysis. When I did this, I said, okay, the probability of me hitting my price target of 35 bucks, 66% in a bull market that's taken off historical studies. So what I do, I set my stop loss, 24.44. My target, 35. Risk-reward ratio, weight the probabilities to it. You get a good risk-reward ratio. I think I always go over 5. The minimum is over 3, because if you make about 35% profitable trades, you lose money on 1 out of 3 of them. It's technically impossible to make money if your ratio is any lower. Think about it. So, risk management strategy, and all these lines, they all have their own significance. Green are price target, support levels, stop levels. The blues, they're major trend lines for the pattern and major levels to break through. So you just have to have a risk management strategy in place. Next one. Risk management is good management. I bought right there. I bought right there at about $105, $110. It got down to 65. That's horrible. Imagine if you bought that for your client at 110 and he set, and you held on to it as it went down to 65. Thank God I had stop loss at about 105. So I got out with a 4% loss instead of a 40% loss. Risk management is good management. Divergence analysis, and I'm sure that you can relate to this right now. This is gold. This is the momentum of gold. The greens, that's going to be called bullish divergence, where, like, even though if a stock's going down, this is actually a measurement of the force of selling. If the selling force is actually declining while the price is declining, that means there's going to be a reversal. Exact opposite for a bearish divergence. If buying pressure is decreasing as price is increasing, that means we're at a top. Or we will be soon. I bought gold right here on this breakout. It got up, everything was fine and dandy. The price got even higher, and then that happened. And then that happened. Feels bad. But you can use it to predict tops. Now, something a little more relevant to you. Remember 2009? 1, 2, 3, 4. 4 signals that the bear market was over. Just because we did technical analysis, just because we ran a couple equations. Crazy, right? And of course these red lines, that just represents overbought and oversold. Notice that we're getting a little overbought right now. The Elliott wave. Okay. I'm sorry I keep mentioning this. I just love it so much, and they always laugh at me for doing it. But it's a method of plotting key ratios, trying to predict the market via proportions of time and price. And actually, the price target from this is 13,721 on the Dow. Let's just remember that number and see if it gets there. And I think the time target's sometime this summer. Once again, Elliott wave, that's the subjective one, so I might be wrong. So you don't trade alone on that. You just use it to keep in the back of your head and understand what the actual trend is. Understand what can happen, predict or believe what should happen, using conjunction with other things, and it's a very powerful tool. Program trading. This is backtesting the golden cross, which is, if you listen to CNBC a lot, the golden cross is when the 50-day moving average crosses above the 20-day. The death cross is when the 50 crosses below the 200-day. So 50 above the 200-day, golden. 50 below the 200-day, death. So I backtested it. Actually, turns out that in large markets that don't really trend that much, and by don't really trend I mean not gold since 2005, it outperforms a little bit. And it actually has pretty low risk, low standard deviation, low Ulster index, not too many losing trades, and actually not that many trades at all. So it's a pretty good strategy. Why does it work? Maybe because just of trend acceleration causes, like the 50-day when it crosses above the 200-day, that's supposed to mean that we're in an uptrend, and vice versa. So you can actually optimize and backtest those strategies. Now, something that might be very relevant to today, new era thinking. I have the inflation and cyclically adjusted, I use a moving average, of earnings to price, plus a 1 standard deviation volatility band, or Bollinger Band. Notice, when price gets above it, watch out for a recession. Watch out for a recession. Watch out for a giant recession. When price gets below it, look out for a recovery. Now, where are we right now? We're in the middle. But let's think of it a different way. If we don't make this adjust for volatility, we don't make it a new era of growth, and we just plot an average with 1 standard deviation of all the data on both sides, we're actually right on the upper rim of the average. We're still slightly overvalued. So that's just another thing that we do. The last thing we do, we love watching institutional money. That's how you make money. Institution, make a lot of money to push the price. For instance, this is commitment of traders. It turns out that small speculators and large speculators, they're dumb money. They're almost always wrong. Commercials, hedgers, they're almost always right. So what can we do? We look what the commercials are doing, we look at what the speculators are doing, and we don't do what the speculators are doing. So currently, at this, what is this, the Treasury bond, speculators were so, where is it? Speculators, a little while ago, there we go, large speculators, they were so bearish on bonds. What happened to bonds? They went up. It's just like contrarian indicators. Okay, now to talk about intermarket and cyclical analysis. This is what I actually wanted to talk to you tonight. Just teach you a little thing that you could perhaps use in your classes, maybe even teach it. First, markets in general, and I've also mentioned this to econ faculty, they're driven by cycles. We have the short-term 4-year, we have the secular 14 to 16 year, and then we have the long-term K-wave, the Kondrativ wave. He was a Russian economist, I believe. It goes along with major market movements and innovations in technologies, shifts in world power, economic power. China's probably going to be the next one. So, main trends. Kitchen cycles, essentially every 4 years there's an economic slowdown and a recovery. Example, example, examples, all these examples. Note that 2007, 2008 housing crisis, we're about 4 years out right now, so you might want to get ready for a little bit of slowdown coming up. Okay, continue. When there's a recession in these cycle troughs, in order, bonds will peak first, stocks will peak second, commodities will peak third. On average, stocks peak 7 months before the actual recession. The market is a discounting mechanism. I will agree with the EMH people about that. The market is a discounting mechanism, so whatever's happening today, it's digesting what the market's going to do in 7 months. Bonds usually peak a little bit before that, a couple months. It used to be a much longer term peak, and actually, with whatever the Fed's doing right now, that might actually be a moot point. And finally, commodities, they peak right before a recession. Think 2008, right before the recession. I think it was July oil prices peaked.